Hello and welcome. You are watching First Take here on News 9. I am Suyash Maheshwari and with me in the studio as always is Amit Ranjan. It's a Wednesday morning, but the stock markets in India, they are closed on account of Maharashtra Day. So no trading in derivatives, equities, SLBs or currency derivatives. Also interest rate derivatives are on pause today. However, there's an exception when it comes to the commodity derivative segment. While the morning session from 9 a.m. to 5 p.m. is closed, the evening session will still be open from 5 p.m. to 11:55 p.m. And while the markets here are on a pause, we still have plenty to discuss with you. Later tonight is the US Federal Reserve policy decision. Back home, we have auto sales numbers for the month of April that will also come out. But before we get into all that, as always, let's begin with a quick check on equities around the world. Amit, a sell-off ahead of policy decision, isn't it?
Yes, and it was a sea of green yesterday. It is a sea of red today. Asian stocks also declined with focus on the Fed meeting. After labor costs jumped, the Fed is likely to keep rates unchanged again this time. Dow Jones closed in the negative by as much as 1.49%. S&P 500 slipped to the negative at 1.57%. Nasdaq 2.04% in the negative. That's where it closed yesterday. Stock 600 0.68% in the negative. Hang Seng slightly muted, 0.09% in the positive. Nikkei also is in the negative this morning at minus 0.12%. US futures have slipped. Options are worried that the US Fed will be keeping their rates at the maximum it has been in years, for the maximum number of time. So that is the worry in the US markets, and that's where you see the red everywhere.
All right, red everywhere as far as the equities are concerned, but we are also seeing, as far as the other global cues that we track, the US 10-year bond yields, they have risen again. Yesterday, remember, we were at around 4.6% on the 10-year, but now they have jumped by about 7 basis points to 4.67%. Keep in mind that higher bond yields offer better return to investors, making them more attractive than stocks. This shift can also lead investors to sell stocks and buy bonds, causing a drop in prices. Now, Goldman Sachs, I was reading this report which over there they analyze market data from the 1980s, and according to it, whenever the 10-year, whenever it has reached around that 5%, it's usually a red flag for equities. Remember, the 10-year got to that threshold of 5% back in October 2023 for the first time in 16 years. We the 10-year had not reached that 5% mark before actually October 2023. The last time it was there, it was back in 2007. So the question now really is, are we heading back to that mark? I mean, only time will tell, but speaking to the experts, it seems that we are on the path, especially with the expectation that the interest rates will be held higher for longer. As for the dollar index, it is also climbing. The dollar index is back above 106 levels. Currently, it is sitting at around 106.4. Now, higher yields and a stronger dollar is not only bad for equities, but it is bad for gold as well. And this is because higher yields mean better returns on bonds, which diverts investors from non-yielding assets like gold. A stronger dollar also makes gold costlier for foreign investors, thereby reducing the demand. The yellow metal overnight slipped over 2%. Spot gold is now quoting at under $23 per troy ounce, and it has fallen about 6% from its record high levels. So we are seeing some bit of a correction in yellow metal prices as well, but it's not all that bad. Oil prices, they have fallen for the third day in a row actually on rising crude inventories and production in the US, and this is also along with increasing hopes of a ceasefire agreement in the Middle East. Brent crude as we speak is now quoting at about $85.5 a barrel. Moving on to the big Q that we are tracking, the US Federal Reserve policy decision. This it will be out later tonight. I mean, we'll only get to react to it come tomorrow when the markets open. But I think at this point, most of us are not expecting a rate cut, especially considering the disappointing economic data for Q1 that has come out, last week, which indicated that the growth in the US, at least on a quarter-on-quarter basis, that is slowing down and inflation is on the rise. I mean, it's a double whammy for them, pressure from both sides. So I think as far as the policy decision is concerned, more than what happens with the rate cut, because again the broader expectations is that the Fed will hold the rates. What would be keenly eyed by the street is what Mr. Jerome Powell, the Fed chair, has to say. Remember, back in March, after the last policy decision, it was Mr. Powell who shared a much more dovish outlook, even suggesting that there could be as many as 3 rate cuts in calendar 2024. And since then, a slew of hotter than expected inflation data as well as jobs data. I mean, we have had 6 or 7 data releases since then, and look at how the narrative has pretty much changed over there. That has pretty much put the Fed on the back foot. And after Mr. Powell spoke after the March series, a number of the voting members from Federal Reserve, they have said perhaps it's time to rethink our monetary easing policy and look at keeping the interest rates higher for longer, perhaps even looking at raising interest rates in the future if inflation does not come down. I mean, from narrative of about 3 rate cuts, Amit, it was 2 rate cuts, 1 rate cut, no rate cut, and now they are talking about rate hikes.
Rate hikes, and a jump in labor costs does not augur well for inflation. So a rate cut definitely is not likely to happen today. A rate hike, now that will be interesting, and how that will play out in the markets. Will it be, I mean, Nasdaq has slipped to the maximum, so has S&P. Is it going to be a big slide? I mean, bottoms opening up. Wait and watch. Right. Today evening is going to be a big evening in India.
It's going to be a big evening for equities around the globe. And also, of course, if the Fed does decide to hold rates and maybe down the road they do decide to increase rates from here on, what would happen is that bond yields will continue rising, and that again, we were talking about this 5% threshold. If we get there once again, that could be problematic for equities, not just in the US but emerging markets. I think more for the emerging markets, because I mean, at 4.67%, if like the bond yields are currently quoting at 4.67% to 5%, if that is the kind of return bonds in the US, which are virtually considered risk-free because it's backed by government debt. So if you are banking on US Fed to not go bankrupt, I mean, that makes it pretty much virtually, risk-free. So if that goes to 5%, I mean, you would expect a much larger equity risk premium for investors to bet on the equity markets. And historically, what we have seen is that whenever they are at a rise, they offer a certainly better return, and for risk and averse investors, it makes sense for them to park their money over there, and that also causes a sell-off in the emerging markets, and India will not be insulated. We are seeing that. We are seeing some signs of it already playing out. After FII stayed net positive net buyers in the Indian cash market for the last 2 months. In April, they actually sold off, and they sold equities worth 40,000 crore. Now, you may wonder, why have we not seen really the effect of it on the Indian markets? Because the DIIs, your domestic institutional buyers, they have been constant buyers. In fact, if your FIIs, they sold around 39,000 crore of equities, the DIIs bought around 40 to 45,000, more than offsetting the sell-off created by them. And if you look at the past, historically, whenever there was a sell-off from your foreign investors, it would impact the market, and it would be we would enter that rough patch. But in the last 12-15 months, even when FIIs have been selling incessantly, your domestic institutional investors, they have been constant buyers, and they have been taking the market to new, fresh peaks. Also, the retail investors, they have also, the surge in retail participation in the Indian markets, that has also helped Indian markets since COVID breakout. So, FIIs, what do? It's not as big a factor as it was perhaps a couple of years ago, but it's still keen to track, and what Fed does will directly impact that. On that note, let's take a short break. On the other side, we have plenty more to discuss on the Fed policy as well as auto sales numbers for the month of April.
The football is mother of all games.
It is a team sport.
The leadership attitude is taking the ownership.
It's always a big responsibility to take decisions, and the right decisions.
I always question the stereotypical.
And that's why you are in that position.
This and more. Streaming on News 9 Plus. Subscribe and get free vouchers.
जानना है तो देखिए, समझना है तो सुनिए, सीखना है तो पूछिए, और कमाना है तो खरीदिए। जानकारी, सलाह और निवेश सब एक ही सुपर ऐप पर। पैसे का सवाल है तो जवाब है मनी 9। आजादी पैसे की, अभी डाउनलोड करें।
Welcome back. You're watching First Stick here on News9, and we were discussing what the federal policy decision would be, which comes out later tonight, and how it will impact Indian markets. Apart from the FII flows, it will also, impact what RBI does next. Remember, no central bank can operate in silos. So does that delay rate cut here in India as well? Because remember, unlike in the US, we are in this Goldilocks sort of a situation. Look at the growth data that has come out. The GDP growth rate has far exceeded expectations, and on top of that, your PMI data, the producers managers index data for both services and manufacturing, they have been constantly rising. I think PMI last month was at a 6-month high for the manufacturing industry. For the service industry, I mean, on a month-on-month basis, it increased, but not as much as the manufacturing side of things increased. So we are in this Goldilocks situation. Let's not forget that inflation in India has been coming down rather nicely. We on a month-on-month basis, inflation has been falling, and we are below at least that 6% threshold, which is, remember, RBI's tolerance is 4% plus or minus 2%. So the upper band of that tolerance limit is 6%. We have been below that for the last 4-5 months. So RBI perhaps could be tempted to cut interest rates, but then again, cutting rates would further eat away from the spreads between the bond yields here in the US and in India. Look at, the price chart, the graphics that we are playing on the screen. The 10-year, the differential between the 10-year here and in the US is about what? Less than 3%. Before COVID, it used to be at about 5%. So for investors to, for foreign investors again, to invest in our debt instead of the US debt, they would be compensated by over 5%. That's just alone in the bond yields. Now that has shrunken, and and it's below that, almost half. I mean, 2.5% to about 3%. So that certainly reduces the attractiveness of Indian bonds. And if you look at RBI, they wouldn't want to do that either, right? This is also because we are just going to be included in global bond indices. Remember, the Indian government bonds will be included in the JP Morgan bond indices in tranches starting June of this year. Then next year from January, Bloomberg bond indices will also be including Indian bonds in the as a part of their emerging market bond indices. So perhaps to keep the bond market happy, they wouldn't want to eat away that differential or that spread that is between the 10-year here and the 10-year in the US. So what RBI does, I think that will be very interesting to see, because at least looking at the situation, it looks like they can go for a rate cut, but again, we can't operate in silos. We can't, jump the gun and do something ahead of Fed. Maybe they do that, only time will tell. But another key, cue that we are tracking today is the April auto sales data. I mean, Amit, I'll come to you on this. The April sales data, auto sector one, has been in focus for the last 12-15 months. It has been an enormous wealth creator for investors as well. And not apart from this premiumization theme, we have also seen a good bounce back in demand, especially for your two-wheeler segment, and they are expected to post really good numbers this time around.
Bounce back, you used just the right phrase. Hero Motocorp jumped 27% two-wheelers. Passenger vehicles, now few things have happened in passenger vehicles. The waiting time has gone down, so that has basically given a jump in demand to passenger vehicles. Maruti Suzuki still has the lion's share as far as market share is concerned, but the maximum growth in the two-wheeler segment has been recorded by Mahindra and Mahindra, going up almost 10%. Maruti Suzuki passenger vehicle sales went up 8.1%, Tata Motors 8.6%. What is a laggard is the truck and tractor division. So whether it is the M&M tractors, they went up only a modest 0.3%. Ashok Leyland, they went up 6.4%, but they have basically been a laggard. Now I'll come to the two-wheelers. Now two-wheelers, Hero MotoCorp, the sales were, the figure was 5,05,000 for the month of April, and it was a jump of 27.5%. In the second place was Bajaj Auto in the two-wheeler segment. The number was 3,64,500 and 64,000, and it grew by 9.9%, almost 10%. In the third place was TVS Motors, but the growth of TVS Motors was as much as 18.5%. Eicher Motors, the ones who sell Bullet Enfield in India, they grew by as much as 14.9%. That is a heavy vehicle, a two-wheeler, and not a family vehicle. But still, even that saw a growth of 14.9% in the month of April. It is looking good. Probably the commercial vehicle sector post-elections and post-new infrastructure projects will pick up also.
And that ties us back to, this entire narrative and entire conversation we have had over many past months, about rural demand, which is still lagging, and that remains a pocket of the market that has still been struggling. And that has not only, hurt your normal consumer staples, it is also hurting, as Amit also pointed out, the demand for your commercial vehicles as well. And I think that is the pocket of the market that one needs to pay close attention to. What's the recovery looking like? Because again, remember, we are in this high interest rate regime. So, but for one, auto demand has not taken a hit, but commercial vehicle demand, remember, for auto sales loans, I mean, the interest percentage is at about 8 to 9%. For tractor loans, it's 13% to 15% and could even go higher from there on. So the sales data for, I think, the commercial vehicle segment, as Amit also rightly put it out, will be keenly tracked by the street. But let's look at the stocks, Amit, because they have done again phenomenally well in the last 12-15 months. I'm looking at the passenger vehicle stocks. Maruti Suzuki has delivered 46% returns in the last 1 year. Tata Motors, it's up over 100%. So it has essentially doubled investors' wealth in that 1 year time frame. Mahindra & Mahindra, after this XUV 3XO which was released, skyrocketed and went on to scale a new record high. That has also delivered returns of about 74%.
Yeah. Maruti Suzuki is the most interesting one. We discussed their results, and they were robust results they posted for the quarter gone by. It is still, it seems, a situation of buy on dips, because in the last 1 month and the last 1 week, they have not posted very good earnings. Rather, some in the last 1 week, they are in the negative. Right. So that is the most interesting one. But obviously, with the results coming in, it is a sector that is bound to rally, and post-elections with new policy, even I'm sure the commercial vehicles division is the run, basically upswing is just round the corner.
Alright, and as for Maruti Suzuki, I mean, the numbers as far as the volume growth and profitability was concerned were decent, but what disappointed the street about Maruti Suzuki was the compression in margins. Their margins came down, and that, again, you have to look at how, the commodity prices, which are key raw materials to these industries, that have acted in the last few months. Look at oil prices. They have been on a surge on a month-on-month basis. We were at about $79-80 odd dollars on Brent. Now we are closing in on $90. We have in fact retraced from then, but we spent a good chunk of April around that $87 to $90 a barrel. So oil prices jumped. Also look at commodity prices, metal prices. Look at copper. Copper is at a multi-month high. I think it's at a 15 or 16-month high. So these key components definitely is going to, put some pressure on the margins of these auto companies. So maybe there is some pain point as far as the numbers, at least for this quarter, are concerned. But again, we need to talk about, for sales, there are two components to it. P, your price, and Q, your quantity. Quantity, that's on the rise. The volumes are increasing. We are seeing healthy growth across, at least in the passenger vehicle as well as the two-wheeler segment. What I think, the street will be looking for is the P, the price. How will the price hikes happen, especially as we, enter the later half of this year, which is the demand season? And
this sector is in for a transition, whether we like it or not, at least in the next year and the few years to come, with the EV segment joining in. Right. How that will play out. Tata Motors is the #1 over there. Tesla has a very kind of plans over there. They are going to come in the premium segment, and they are going to make very cheap cars. How that is going to play out for the domestic players? The red carpet has been opened for Tesla. Right. So duties have come down from 70% to 15%, that much. So this segment is going to go in for a transition, and this year will be interesting for this segment, the auto segment.
The year is going to be interesting for the auto sales. Remember, the auto sales numbers are due today. They'll start trickling in any time from now. We'll have the full numbers, the consolidated numbers only by the evening, and we'll bring that to you in the evening show. But with that, it's a wrap on this edition of First Take. Thank you for watching. Coming up next is World Business Report.
अगला स्टेशन विश्वविद्यालय है। दरवाजे बाईं तरफ खुलेंगे।